Hi everyone, my name is Chris Tubby, founder of Trading for Tomorrow, and I'm just going to take you through my macro outlook. Okay, so let's take a look back at last week to start with. So it was a mixed week for stocks, with Powell's testimony eventually sending stocks lower, and then Friday's NFP sending them to new highs. Uh, Actually, the S&P is up 25% since October. But of course it started to fall a little bit in the second half of the session. And the video rallied 5% to make a new all-time high before falling 10% all in the space of 6 hours. However, this seemed more likely to be investors sort of changing assets, sort of their asset allocation, moving out of some of the Magnificent Seven stocks, such as Nvidia, into some of the others which are a bit more lagging. And of course, after it hit that long-term resistance point that began in 2018, then 2021, and Friday's high, whether that was the cause of the sell-off or whether there's something a little bit deeper in that, I am not sure. And then gold and Bitcoin also made new highs. Gold 2,200 and Bitcoin 71,000. WTI also rallied a little bit and tested, just 1 cent short of $80 before dropping to close below $78. And the dollar continues to weaken, with the Dixie testing the 102.60 support level, so keep an eye on that one. I must say that pivot points worked so well last week, they were amazing, and across a variety of different assets as well. Again, looking at the data, NFP was higher than forecast. However, there were some big downward revisions on the previous months of this year so far. Plus, we also saw weaker wages, and the hours weren't so great. And we did see a rise in the unemployment level from 3.7 to 3.9%. You know, I keep pointing out that this is something that I expect to continue. I was surprised it didn't actually start so much last year, but now I think it's going to pick up pace. And it's not just in the US, but I think you're going to see it in most countries. You know, there will be less job offers around. Indeed, in the US, you know, the jobs that was available to those sort of people that are able to work peaked at 2 to 1. So 2 jobs for everyone that was unemployed that wanted a job or could have had a job. But that's now dropped down to about 1.4 to 1. And, you know, many employees will now opt for job security. That's, of course, if there is such a thing, rather than moving for a higher wage. And, of course, those higher wages are going to become more difficult to find now that inflation is well off the highs. You know, it's very difficult to argue for a 5–10% wage hike now. So lower employment levels will also reduce demand, and again, that will help to bring inflation down to central bank's 2% target rate, as long as obviously it doesn't crash. The employment levels, of course. So although recent hints from the Fed and the ECB seem to show that the first rate cuts are likely to happen in June, I'd actually predicted that as far back as last year, especially for the Fed. It does demonstrate that they are either confident that inflation will continue to slowly drop and hit their target, rather than increase anymore, or they're finally prepared to be just a little flexible on that 2%. So if rates do start to slowly fall, and emphasis on slowly, from the summer, you know, just don't expect too much, especially too soon. I think that, you know, it's just going to be a very slow process, because they've been scared by this inflation and they're not going to want to see it return. But of course, you know, if we do start to see those rates come down, maybe for the US they will manage its Goldilocks economy. You know, they've got GDP at 5%, 10-year treasuries at 4%, inflation on its way to 2%. The closer it gets, the stickier it gets. But so it's just a matter of when they will get that. And sort of when we look at forward earnings estimates of corporates, they're at records. Plus, of course, we should not forget it's election year. It doesn't mean that they can't crash, but it's less likely, shall we say. Other economies may touch a technical recession, but as rates start to fall, it should prevent anything more sinister. That said, we've still got to see probably the impact of refinancing after those sort of cheap levels disappeared after COVID. And that's likely to happen over the next year or two. And yes, rates will fall, but how far are they going to go? I expect them to bottom out sometime in 2025-26, probably around 2.5% to 3%. I can't see them going lower than that. That's of course unless we hit another crisis. And of course they do seem to be coming more frequently. And of course, what will we focus on? Once inflation and rates move away from our radar, perhaps it's going to be debt levels. Household, corporate, government. Surely they just cannot continue to just keep increasing indefinitely. Governments only have a couple of options really to sort of cover their debt, and that's obviously to borrow from new investors to repay the old ones, sort of like a revolving debt, or raise taxes. Of course, they're not going to do that in the election year, but who knows what comes after that. So Friday's sell-off in the afternoon for the indices and Nvidia demonstrate just at times how vulnerable these markets can be, even when they're in such a bull run. But saying that, I think it's healthy for the occasional shakeout. And, this weekend is the 15th anniversary at the bottom of the subprime crisis from where it reached in March 2009. So just thought I'd throw that in there. Okay, let's look geopolitically. There's still tension. Israel continued to advance deeper into Gaza. Houthi are responding by attacking more ships that are entering the Red Sea, with the US and the UK having to shoot down as many of those drones as they possibly can. Russia is still making slight inroads in Ukraine, as Ukraine really are desperate for the restocking of weapons. And as I say, it's more about the lack of arms that's making them sort of lose ground rather than anything else. And of course, when you look at that, most of this is not being held up for cash, not being held up by a lack of supply. It's actually being held up by politicians. A little reminder, the US and Canada changed their clocks this weekend. Europe has another 2 or 3 weeks to go. I'm not sure. It's basically the end of this month, I think. This week we have a lot of data from the US being released, including CPI, so again inflation data there, retail sales, what's the consumer spending, and industrial production. Again, that's faring a bit better than most countries, but still not fantastic. But it will be interesting to see industrial production that's going to be released in Europe, as that does remain weak. And then in the UK, we're going to see one of the Bank of England's metrics, which is wage growth. It's helping them to identify how strong inflation is going to remain. Japan releases revised GDP, and China will release its medium-term Linden, and finally India will release its inflation data. So I hope that gives you a little bit of insight into what's possibly coming soon down the road and even longer down the road. I hope you'll stay with me and you will join me in part 2, where I do some technical analysis on a variety of products that I trade. Now, I just want to sort of just talk a little bit here about my services that I offer. So there's a daily newsletter that includes global news, headlines, my views, full articles. That is a subscription service. There's one-day workshops. This will help you to discover if trading could be your next career or even just a second income. Otherwise, maybe you're already trading, but there's a few gaps that you'd like to fill in, and I can help you with that because that will accelerate your trading and your performance. And then there's a 1 week intensive course. That's going to make you feel competent and confident after just 1 week. It's going to give you those foundations that you need to build your trading career on. And if you've got that in a trader, we'll find it. And now that does also include a free trading challenge. Then I do a Flexi Masterclass, which includes 6 weeks of guided learning. They can be split up. You don't have to take them all at once. And this is designed to provide you with all the knowledge and trading tools that you're going to need to navigate any market and also on any asset class. I trade them all. And as I say, you can spread those weeks out over months if you need to. It's no problem for me. And again, that does include a free trading challenge. Now, trader mentoring, I'm doing more and more of this. And this is to help you reach that next level time and again. And I'm doing much more in the way of one-on-one sessions right across everything that I'm doing now, rather than sort of looking for big groups. I do provide a lot of trader educational content to individuals, exchanges and brokers. And as I mentioned earlier about the trading challenges, if you're looking for a funded trading account, then you can contact me for details just about the ones that I use, or you can sort of take one of the courses where I'll give it to you for free at the end of it. Okay, so then moving on to our disclaimer, just to make you aware that trading does involve the potential risk of loss of capital and is not suitable for everyone, although hopefully it is for you. And many companies provide leverage, so just be aware that you can lose substantially more than that initial investment. Everything I include in here is just purely for educational purposes. I'm not trying to encourage you to trade or invest. That must be your decision. And of course, before you make that decision, you've got to consider the risks involved, definitely your financial situation, your level of experience, and your risk appetite. And of course, it's important that you only risk capital that you're prepared, but also that you can afford to lose. And if you've got any doubts whatsoever, seek independent financial advice and do that before you risk your capital. So many people come and find me after they lost money, which is sad. They should come to me before. And yeah, so listen, that's it for part 1. I hope to see you in part 2, where I'm going to do some technical analysis.